This is a Brooklyn-bound 2 train. The next stop is
Wall Street.
Stand clear of the closing doors, please.
Welcome back. This is Not Your Advisor with NYU Grad on Friday, August 2nd. I have a lot on my mind this week. It's been a crazy week. There's been a lot of chicanery and manipulation, for lack of a better word. And I feel we need to cover a lot of things other than just the data today and this week. It really was a shit show. Before I dive in, thank you again for everyone that submitted a rating and a review on Spotify or Apple Podcast. Please continue to do that if you haven't. If you take a screenshot that you've submitted, only if you value my Substack and my podcast. I don't want this to be a paid review. Only if you value it. If you submit the rating of 5 stars or a nice review and you value it, send me a screenshot and I will comp you for 3 free premium months. I also have the 25% discount going on for free subscribers as a celebration of reaching and going beyond 250 podcasts from July of 2023. You can see the link on the show notes, or you can simply go to nyugrad.substack.com/podcast25. Again, nyugrad.substack.com/podcast25. So let's jump right into the session. All right. I am going to go through my normal order and just jump around, but there was a ton to cover today, okay? So bear with me, and it'll probably be longer than usual. So we had, let me update my screen. I want to make sure I get the latest information here. We had 490 new highs on the NYSE, 552 new lows on the NYSE. 18% of stocks were advancing versus 79% declining. Looking at the 50-day moving average, we had 57% of stocks on the NYSE below their 50-day. This is a huge expansion. And we had 40% of stocks on the NYSE below their 200-day moving average. On the NASDAQ composite, we had 88 new highs versus 237 new lows. Now, that doesn't tell the whole story here, but let me kind of peel the onion. So let's kind of review this week. So on Tuesday, we had a sell-off. Not a crash, a sell-off. Wednesday, everyone was caught short, and we rallied hard into the FOMC rate decision and Jerome Powell speaking and answering questions to the media. Thursday, we sold off, and I noted on yesterday's podcast on Thursday, I just do not, I call BS on this market, because of how obvious the rally was into the FOMC news event. And then we had a few big earnings reactions to Amazon and a few others like ARM Holdings. And this week has been great for me. Don't get me wrong. I made a lot of cash this week. And these are the type of weeks that I live for, because I don't trade every day. I don't make thousands of trades a year. I'm more of a sniper mentality. I will wait patiently in the dark waiting for the opportunity because I don't have the advantage of size. I don't have the tonnage that some of these broker dealers and the sell side have, where they're making pennies on every transaction, right? Like I need to make my profits efficiently and quickly, in and out. The lack of size is my advantage. However, I just want to say that despite the fact that I've made more this week than pretty much all the folks I know that work at Adobe, Google, etc., on a salary basis this week. And I'm not boasting here because next week I could lose all of that. But by adopting some of my strategies and being patient and waiting for the right opportunity, that's how I trade. I trade the edges. I trade auction market principles. I look for balance areas. Are the markets in balance or not? But despite all the success this week, I'm still pretty not depressed, but melancholy, disappointed, disenfranchised with how the markets are behaving. But they're behaving, with all that said, very predictably in the conditions that we're in, which is a binary market where basically 40% plus the composition of the S&P reported this week through like 3 companies. It's like all or nothing type markets. And when you have even 1 or 2 of the Mag 7 crashing, that's bad news because everyone is in them. Now, when you have 6 of 7 crashing, you have problems because, like I said, DraftKings, Roku, Carvana, GameStop, these little stocks are not going to replace Amazon, Google, Meta, Apple, Tesla, Nvidia because of just tonnage of size. Those companies on the Mag 7 are so big, they're like 40% of the S&P 500 or some crazy number. And I've been posting all the ETFs that own these stocks. The lowest numbers, like 800 ETFs to like 1,400 ETFs that own these stocks. What does that mean? And I posted the other day about how dangerous it is to hold stocks blindly forever. And I keep referencing Starbucks. I keep referencing Intel because if you bought Intel on the last time it boosted up during the .com craze and you never sold that, you'd have to wait 14 years to get your money back. And there are thousands of retirees that are retiring every year. God bless them if they can. There are also people who can't retire anymore in the advanced age because of inflation and insurance costs and healthcare. This is a very big problem. Man, I'm really going off on a tangent here. I told you this was going to be a long podcast, but let me try to get back on track to some degree. So I've been also sharing, throughout the years, a Excel spreadsheet. And I'm amazed that many working adults did not know how to calculate this spreadsheet. It's in the show notes in the free section, right underneath the Ifani video. It basically says, how many percent of loss you have from 10 to 100% loss and what percentage gain you need to break even. So the more you lose percentage wise, the more you need to gain to break even. And I don't understand why this is not taught, or maybe it was taught to most people and people just forgot. So let me just break this down. I'm not going to go through every tier, but you'll get the picture. If you lose 10% on Apple, you need about 11% gain to break even on that loss. If you lose 25%, you need 33% gain to break even. If you lose 50%, you need to make 100% gain from after the loss to break even. If you lose 80%, you need to make back 400% to break even. And that's one of the reasons why, especially in the overbought market, toward the end of the cycle of a bull, no matter how good the entry is, how good the setup is, my stop loss is no greater than 3% loss. I'd rather lose 2 to 3%, recheck myself, reevaluate the trade, and re-enter, and lose again 2-3%, reevaluate, and re-enter, because I'm playing the edges of the balance area. And if it still doesn't work, the trade was wrong. My analysis was incorrect, and I need to move on, or my timing was off. But I am going to share this spreadsheet grid on every show note moving forward. I shared this with a few people, and they kind of played it off like, yeah, I know. But once I started to really talk about it, they're like, oh man, I didn't realize when you lose 60%, you got to make 150% to break even. It's no joke, people. And Intel's down like 28% from like 2 weeks ago. So you need to make over 35% just to break even. So that's something that I wanted to share with everyone and remind folks, if you did not know. I said on Thursday, Friday, it was going to be a doozy, and it was. And I still stand by that. I think Monday is going to be another doozy, unless over the weekend the Fed makes some type of statement, they leak a statement. It doesn't have to be not Bernanke. That's how triggered I am by the Fed. It doesn't have to be Jerome Powell, but it could be any of the Fed heads that leak some type of statement that says we're now thinking about cutting rates before September because of what Japan did. Unless that happens, we're in for, I believe, more selling on Monday. So what happened on Thursday night? So obviously I was sleeping. I was not tracking this, to be quite honest with you. But there are many smarter folks than I, like Bill Cara and Metals, Oil and Mining, Aloysia, who posted today about what happened in Japan. And Rubino posted about this as well. So for those that don't know about the yen carry trade, it's similar to what you see with the VIX. They pummel the VIX and they go long other assets with the money that they make pummeling the VIX. But think bigger. Think bigger than that. Think the ECB, the London Stock Exchange, right? The U.S. Federal Reserve. All of the central banks, the big ones, they, in coercion or agreement with the Bank of Japan, for decades, they've all agreed to pummel the yen, to crush their their currency, and to crush their people. That's why when you go to Japan, if you've never been there, if you want to buy a bowl of ramen or a McDonald's Big Mac meal, it's like 40,000 yen. They've been crushing their currency for decades. And it helps with the exports, right? It helps because it's cheaper to buy their stuff. and it promotes tourism. You know, if you're a U.S. citizen or British citizen, you go to Japan, things are much cheaper. I saw that when I went there, and I wanted to get, Suntory whiskey or something. It was like $3 a glass, U.S. dollars. I'm actually having a glass of Suntory. I made a highball for this show because it's just been a crazy week. So they've been doing that. And what these central banks do is they will short the yen. As the yen craters, they're making money, right, on that short. They take all of those profits and go long Apple, Google, Meta, Microsoft. They buy bonds. They buy, all risk assets. So it's like free money. Free money. It's like saying, hey, look, you and I are partners. I will make sure somehow, some way, Apple will fall every day over the course of 20 years. And you just short Apple. And all the profits you make on that short, you just reinvest it into something else. That's a simple way to think about this. So overnight, the Bank of Japan raised their rates. They did this like maybe a few weeks ago, like a month or two ago. And when they said, they're going to raise rates, we're going to be less dovish and we want to protect our currency, no one believed them. Like, what the hell are you talking about? Get in your place. You are a servant. Get in your place, little boy. And no one believed it. So last night they did it again. And I don't think anyone really believes them. But that was enough to accelerate the Thursday sell-off into Friday. And I believe that there were a ton of margin calls because you have so many people. When you have people like Nancy Pelosi who are buying call options on semiconductor index, can you imagine what YOLO investors on Reddit are doing? They're probably mortgaging their home with the equity they made from COVID and going, balls out call options on NVIDIA. So there were a ton of margin calls today, and the selling never really stopped. Even in the afternoon when we had that small bounce, if you followed me on Substack notes or the private chat, you'll have seen the NASDAQ or NYSE up, down volume never really got off the floor. It was just consistent selling all day into the close and even in the after hours. So that was the complexion of the day. I had a few private subscribers saying, hey, I'm going to try to catch some of this bounce. I'm going to go long here on these stocks. I'm not going to mention who or what. But if you want to take a look at that, you'd have to subscribe to the premium. And I just noted to them, hey, be very careful with buying the dips here. Have very tight stops because I still do not see any buying oomph in sight. And I'll post the Vol D and the Vol QD, which is the NASDAQ composite breadth indicator. And it was just nonstop, relentless selling, and it accelerated into the close. So being a paid subscriber would have kept you either in your shorts or out of trying to catch a falling knife. So again, I would welcome you to join Premium for a 25% discount. It is nyugrad.substack.com/podcast25. So I also want to read a quote from Bill Cara, who's had over 50 years as a market professional through Canaccord and many other companies and his own firm. But I'm just going to read the quote. He posted this earlier around noon, New York time. Quote, if investors are concerned about corporate earnings, and they should be, wait until next earnings season in October. Investors should be worried about today's unemployment data. In every case in U.S. history, when unemployment jumped so high in 1 year, a recession followed. With high inflation, a slowing economy, wait until next quarter to see worse numbers and lower corporate earnings, the broad market weakened. These negative market forces led to bear markets. If the Fed and other central banks loosen policies, expect money to flow into bonds, lowering yields, and into gold. If not, the market rotation will instead become a market collapse. At this point, broad market prices are falling, but hedges like gold and Bitcoin are holding up relatively well. How much longer is a question to ask the Fed, ECB, and the Bank of England. So I feel like I don't know everything. There are many smarter individuals than I, and I'm just learning from the best. And what Bill is saying rhymes with what I've been saying on this podcast. So this is the time to really focus in on your investments and your portfolio, and have that call with your financial advisor. I am not your financial advisor, but it's your wealth, it's your money. You need to really focus in on this. If shit continues to hit the fan, you cannot blame others. You have the opportunity to learn and take control of this. All right, so the selling never let up. The 10-year fell to 3.8%. And Bill Cara mentioned a little bit of this. So for those that don't know too much about interrelationships, and I'm not as an expert as Bill, but I learn a lot from Bill Cara. So it's a rotation into safety. Let's say you are a bond seller. Okay, you work on Wall Street and you sell bonds to, the teachers union, the General Motors pension fund, and you're selling bonds to them. If they are all running into your office, trying to buy these bonds for safety, you as the seller do not have to give them an attractive yield, because they're coming to you saying, please take my money. I want to buy bonds for safety. So yields go down as bond sales go up. Pretty simple, right? If you've never dealt with bonds, just think about that interrelationship of yields and price of bonds. They're inversely correlated. And the past 24 hours, the demand for bonds is high because everyone is running to safety. So yields went down from like 4.1 to 3.8. It's not because the Fed cut rates. So that's kind of what's going on with yield and why it dropped so fast, so quickly the past 24 hours. The VIX was up 50% for the majority of the day. When I talk about psychology, this is really important. While I'm up big, I'm also trying not to pat myself on the back, because on Monday we could, over the weekend, see some kind of news flow where it reverses the entire move before the open on Monday. So you have to be humble. You have to take profits when you can. And whether the trade works for you or against you, it's not right or wrong. It was bad analysis. You fix the mistakes and you move forward. We talked a little bit about this in the paid subscriber chat, where some of my paying subscribers had mentioned they regretted selling a position yesterday when it would have made a ton of more money today. So that's where that's coming from. And I just want to reiterate, over 1,192 ETFs hold NVIDIA, 1,240 ETFs hold Microsoft, 1,084 hold Apple, 998 hold Google Class A. You get the picture. This is how this happens. Everyone is in the same effing stocks. So when the institutions need to sell on margin calls, they're selling. And I often ask, will you sell before Wall Street this time? Ask yourself that. If you lived through the great financial crisis or even COVID, I mean, the COVID crash lasted a month and a half, but are you going to be the bag holder? Will Wall Street somehow trick you and sell first and leave you a bag holder like they did with Intel back in 2006? I'm sorry, in the dot-com crash, where if you bought Intel correctly on the breakout, but you never sold, there was a point of no return where you'd have to wait 14 years to get your break even. I don't want you to see that, especially if you're 55, 60, 65, and you're almost at that retirement horizon, and God forbid you lose 50% of your 401k or Roth IRA, and you don't have the 15, 20 years to wait for a comeback. You really need to talk to your advisors and really ask them what their sell disciplines are. And if they keep saying to you, oh, if you sell now, you'll miss the biggest rally ever, you need to reevaluate. You really need to focus on your wealth here. So let's keep going. Let's look at the year-to-date performance, because I can talk. Well, let's look at 1 week and the year-to-date. So year-to-date, it's not that bad, but 1 week, utilities were up 3%, real estate was up 1.5%, consumer defensive was up 0.62%, leading to the downside for the week. Technology was down 4.8%, consumer cyclical was down 4.3%, financials were down 4.09%, energy was down 3.7%, industrials were down 3.3%, and basic materials were down 2.5%. Year to date, magically, because we had such a big rally this year, we're still green in most sectors. Can you believe that? Communication services, which include Meta and Alphabet, are up 16%. Technology is still up after today's carnage. Tech is still up 15%. Utilities is up 13%. Financials up 10.4%. Consumer defensive up 10.3%. So I know, folks, and the reason I'm going through this is today, even though it was panicky, I know folks who have 7 to 8-figure accounts. And today, this week, was a blip. They're like, yeah, I lost $400. Yeah, I lost $800,000 in my portfolio. It'll come back. It'll come back. It always comes back. They'll announce some type of cut. It'll come back. And this is why. They are up so much. There's no panic yet. But again, I'm telling you all, it is time not to panic, but to really get your house in order and start to evaluate your assets, whether it's stocks, real estate, bonds, your business, etc. So what stuck out? Nothing was spared other than precious metals and Bitcoin. What was strong today? I'm going to just go through this, and a lot of this is either going to be volatility longs or short ETFs. So UVIX up 47% today. UVXY up 35% today. Volatility index up 26%. SOXS, which is short semiconductors, up 16%. TZA, which is short IWM, up 10.7%. DoorDash up 8.3%. You also had DJT up 7.3%. That might be political headwinds there, or tailwinds for Donald Trump. And you had Ferrari, which was up 2.8%. That's weird. I'm going to have to look into why Ferrari is up 2.8%. What was weak? I'm only going to go until the 5% down. Because, again, I'm not going to... It's already going to be a long podcast, so I don't want to go for hours. All right. Intel down 26%. SVIX down 21%. SOXL down 16%. Beazer Homes, because there's no rate cut, down 12.7%. Bitfarms down 11.3%. Hut 10.7%. Wolf 10.7%. DraftKings 9.7%. Amazon 8.7%. It was down over 10% at one point. App Lovin 8.4%. ASML Holdings 8.4%. Lamb Research 8.1%. Riot 8.05%. UCO 7.5%. IREN 7.2%. SMCI 7.08%. ARM 6.6%. Restoration Hardware 6.6%. Synopsys 6.4%. Shop 6.4%. Carvana 6.3%. Sweetgreen was down 6.2%. Hovanian 6.1%. Red Rock Resort 6.1%. Crocs 5.7%. Dell 5.6%. SMH 5.4%. Marathon 5.2%. It just keeps going. So you can check for yourself. I'll link all the tickers in the show notes. You can check that out. So for the coming week, there's still going to be a lot of earnings coming out, but I don't think they're going to matter as much as the Mag 7 just in general. So you have to have a laser focus on Mag 7. Just as a heads up, 6 of the 7 have lost their 50-day moving average this week. Continue to watch the 10-year Treasury yield and just yield in general. And really start focusing on your portfolio of assets. And when are you willing to sell? Are you going to either, regardless of whatever happens, just hold and YOLO and HODL for another 20 years? Or are you going to plan around this, depending on your age? You need to schedule, at bare minimum, hour to 2 hour session with your financial advisor to talk about this. With that, I hope you all have a great weekend. For premium members, please stay on. We're going to go through like 25 charts today. That's my train.
Stand clear of the closing doors, please.